What are the key aspects of global finance and strategy? This video delves into the understanding of finance sources and risk management techniques. Explore the elements that shape corporate financing decisions and equity capital. Financial managers face crucial decisions in corporate financing. They must evaluate options and considerations carefully. Debt, defined as something to be repaid, plays a significant role. Short and medium-term debt finance options include trade credit and bank loans. These options provide essential liquidity for businesses. Trade credit allows businesses to defer payments to suppliers. Bank credit facilities offer overdraft options for flexibility. Bank loans, typically lasting 5 to 7 years, are another option. Debt factoring accelerates cash flow by using company debtors as security. Invoice discounting provides immediate cash against selected invoices. Leasing involves payment for equipment use over time. Hire purchase requires a down payment followed by monthly charges. At the end, ownership transfers to the user. Both methods spread costs over time. They are crucial for managing business cash flow efficiently. Long-term debt spans over 10 to 30 years. Lenders have no control over borrowers beyond the loan agreement. Interest rates can be fixed or variable. This interest is treated as an expense for tax purposes. Capital is committed for a long period, affecting borrower circumstances. Mortgages are secured against specific properties. Term loans are negotiated against fixed assets. Bonds involve lending money to a company with interest payments. Debentures are secured bonds with fixed or floating charges. Convertible loan stock offers conversion to shares at a later stage. Debenture holders may impose restrictions to reduce risk. Limits on further debt and dividend levels are common. Restrictions on asset disposal and financial ratios may apply. These measures protect investors' interests. They ensure financial stability and predictability for the company. Sale and leaseback involves selling assets to a financial institution. The seller leases the premises back from the new owner. This transfers ownership while retaining usage rights. It's a strategic move for liquidity. It can free up capital tied in physical assets. Equity is contributed by shareholders to a company. It involves no fixed charges and no repayment is required. Directors have control over timing and amount. Shares in listed companies are easily disposed of. However, issuing new shares can dilute control and increase capital cost. Reserves are an internal finance source from retained profits. Venture capital supports small, growing companies. Private placing widens shareholder bases without stock exchange listing. The alternative investment market caters to young or small companies. Quoted companies may go public for large capital needs. Trade credit is financing from suppliers over a delivery period. It allows businesses to manage cash flow without immediate payment. This credit is crucial for operational liquidity. It bridges the gap between delivery and account settlement. Effective management of trade credit is essential for businesses. Bank credit facilities provide overdraft options. They can be short or long-term, offering flexibility. These facilities help manage unexpected cash flow needs. They are an essential tool for financial management. Their effective use can prevent cash flow crises. Debt factoring raises cash using company debtors as security. It accelerates payment from customers. Invoice discounting purchases selected invoices for immediate cash. Up to 80% of invoice value can be advanced. These methods enhance liquidity and cash flow efficiency. Hire purchase involves a down payment and monthly charges. Ownership transfers after the payment period. Leasing allows equipment use for a rental fee. Both methods spread costs over time, aiding cash flow. They are crucial for businesses needing asset access without upfront costs. Long-term debt spans over 10 to 30 years. Lenders are creditors with specific repayment dates. Interest is a charge before profit, affecting taxes. Capital commitment is long-term, impacting borrower circumstances. It requires careful planning and risk assessment. Mortgages are secured against specific properties. They involve repayment with interest over time. Term loans are secured against fixed assets. They require financial and operational performance information. Both options provide essential long-term financing for businesses. Bonds involve lending money with interest payments until maturity. Debentures are secured bonds with fixed or floating charges. Both options offer long-term financing solutions. They are traded in secondary markets, providing liquidity. Investors may impose risk-reducing restrictions for security. Convertible loan stock begins as a bond. It offers an option to convert to shares later. This conversion provides flexibility for investors. It usually pays a lower interest rate initially. The conversion option can be attractive for long-term investment. Equity capital involves no fixed charges or repayments. Directors control timing and amount of equity issuance. Shares in listed companies are easily traded. However, issuing new shares can dilute control. It may increase overall capital cost for the company. Venture capital supports small, innovative businesses. It provides equity for growth and development. Private placing widens shareholder base without stock exchange. It is arranged through stockbrokers or issuing houses. Both options are vital for raising capital efficiently. The alternative investment market serves young or small companies. It provides a platform for shares without full listing. Quoted companies may go public for large capital. They must meet specific criteria to trade on the exchange. This market supports diverse business growth. In conclusion, understanding appropriate sources of finance and being able to review techniques to manage global risk are essential for maintaining stability and growth in an increasingly interconnected world. Identifying suitable financing options enables organizations to support expansion, innovation, and strategic investment while managing costs effectively. At the same time, recognizing and mitigating global risks such as currency fluctuations, political instability, and market volatility helps protect organizational assets and ensure long-term sustainability. Together, these skills empower businesses to make informed financial decisions, strengthen resilience, and thrive in the complex landscape of global finance and strategy. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07,484,361,688.